why would people buy ETFs rather than just Bitcoin itself? Well, there's a lot of reasons. Number one, the institutions just can't buy that. They just can't buy Bitcoin in a way that would suffice their compliance and their fiduciary duties. No portfolio manager from a big pension fund wants to be holding keys to Bitcoin, particularly not if you're managing hundreds of billions of dollars. You don't want to be holding keys to $1 billion of Bitcoin. Nobody wants to do that. So, and even if you did, you're not going to get compliance to agree to that. You're going to have to go through hoops, and you have to walk on coals. And so, and the fiduciary and personal risk is just too high. So they're not doing it. And then registered investment advisors who advise clients, they actually invest money for their clients. They have not had the incentive or the ability to do so either because of the same problems. It's not like you can just buy this and put it in a wallet for your customers. These banks, and the investment funds, they use what's called a prime broker. And, this, Brandon, but for your listeners, they use a prime broker that actually custodies their assets for them. And so you would have to have a qualified custodian, and you'd have to have special agreements. Where is it going to trade? Is that an exchange that's has oversight from the SEC? How is it going to settle? Who's going to settle? There's just a litany of answers, questions that have to be answered, and problems have to be solved. Now, and as for the other people, why would an individual buy the ETF? Well, because they don't feel comfortable buying a signing device, what we call wallets. They're actually signing devices, and having that risk. I mean, I'm going to admit, just a few years ago, I did it for the first time. It was nervy for me. I mean, I was like, where is this? How do I know it's settled? And I'm not, at my age, I wouldn't call myself a tech savant, but I'm tech savvy enough. I come from the BlackBerry world, so I'm used to tech. And so, but even for me, it was uncomfortable a little bit, get me outside my comfort zone. Can you imagine someone who's in their 40s, 50s, 60s, 70s who are using a signing device? Like, that just doesn't sound like it's something they want to do. Now, flash forward. Suddenly we have these ETFs that have splashed onto the stage, and you've got this super highway that's built. So it's they're not stocks. They're basically trusts. They're funds, but they own underlying Bitcoin in them, and that's supposed to match the amount of money that people have bought those shares for on these exchanges. So, and it's pretty simple though. Those ETFs own the underlying Bitcoin, and the individuals who are buying that can buy it through their broker, their trading exchange. You can settle it with your prime broker if you're an institution. They can custody it. It's a same settlement process and DTC process for you putting margin on it or whatever you're doing with your regular trade. It certainly requires more margin than something that's a mainstay stock like an Apple or something, but you don't have any of those settlement issues. You don't have any of those custody issues. You know exactly where it's going to be marked. You know how it's going to be custodied, and you don't have to have a special process that's designed by your chief compliance officer, by your general counsel. You just buy it and settle it just like a regular stock. It's super easy. Now, all that said, why have we not seen just a wall of capital, right? We're seeing this, not a trickle, but a solid stream of capital coming in every single day. Larry Lepard had retweeted something this morning that should just the sheer, I think it was from Bitcoin Archive, from Archie, where it's just this steady stream of capital comes in every single day, somewhere between half a billion and $1 billion that are coming into these ETFs. That's new money coming into the space every single day. It's not a wall of capital, but what you're seeing is these on-ramps are being built where you've got these registered investment advisors, the brokers, the institutions, the family offices. They've gotten their compliance in place. They've gotten their pamphlet in place. They can, make their investors aware of the risks, and they can have the check the box and go ahead and buy it and settle it just like a regular stock now. And it's starting to happen across the board, but it's happening steadily but slowly. And that's why I said last night that it's still not priced in. The amount of capital that's going to come into this space is magnitudes of multiples of what we've seen so far. And it's going to be over the course of months and perhaps even longer.
What do you think the 40-year trend of rates?
Yeah, barring any financial, structural, large scale incident, some sort of credit event, barring a credit event, you can see that inflation has kind of settled in around the 3% range. I've said this for a long time. I've been saying this for over a year, that we will have high perpetual inflation. That's what it's going to be. That inflation is due to fiscal stimulus. That's what's going on. The deficits are creating inflation. As that continues and we have that 3% inflation, well, interest rates are going to stay higher. Now, that's the inflation that we're admitting to. I mean, the real inflation is closer to probably to 7% or maybe even higher. And so we're still running rates that are stimulative. What you want is real rates to be negative in order to continue this charade, which means that you're going to allow inflation to continue on. So I don't see rates going to the Volcker era of the 80s. I don't see them going to 16, 18, 20%, but I can see rates structurally remaining higher here for a period of time as inflation continues to run a little bit hot. Does that mean that the Fed won't lower rates? No, I don't think so. I think there's tremendous pressure from the White House in particular, because they want the economy to be roaring before an election. They want to err on the side of inflation as long as it's not out of control, rather than the side of deflation or recession. So they're going to allow it to continue here, which means that I don't see the Fed raising rates. I can see them lowering them a little bit, but then inflation just becomes entrenched here, which I believe it's entrenched at 3%, 3 to 4%, somewhere in there. Maybe it becomes entrenched at 6, 7, 8%. Luke, I think, believes it could get in the teens. It's going to have to, though. Inflation's going to have to get up into the teens in order to keep the debt from spiraling out of control. That means allowing inflation to run hot without raising rates to the point where you're burdening the Treasury with too much interest cost. And then so that's kind of the push and pull there. I believe it takes a long time. I believe that we're on this path of just continuing to grind down other currencies and have them basically fold into ours, fold into the US dollar, while we just keep running these huge deficits and allow our interest rate the U.S. Treasury rate is higher. The 10-year is higher than rates around the world, way higher than the Japanese, the JGBs, higher than Italy, Germany, the UK. It's higher across the board, and so that it just continues to drive money to the dollar and to the Treasury. And so this could continue for a while. And I think what happens, though, is that they eventually kind of lose control, and inflation gets out of control, and people lose confidence in the long-term treasuries because they're seeing how much purchasing power they're losing every single day. And so why do they want to hold something that's 10 years or longer? And as that happens, then rates are going to structurally move higher. That you're going to see hints of it and an inkling of it. You could see the Treasury say, "Oh, we're going to have to issue $2 trillion this quarter. We expected $500 billion," and the bond market freak out. And you could see something close to a bond market failure where it goes no bid. But that's where the Treasury and the Fed step in, print more, and we start the charade again. And that's just another step toward the inevitability of the US dollar going away. And we can't continue on this path forever. They all know it. They've all admitted to it. The Treasury puts out a report every single year, and they labeled the report last year an unsustainable fiscal path. They literally labeled it for the whole world to see, which is a red flag to not to the world. They're trying to warn Congress. They're like, you guys got to stop spending. We can't keep pumping debt like this. And then you've got Powell said it on 60 Minutes a few weeks ago. Yellen has said it. This is unsustainable. It's unsustainable. It's unsustainable. That's the word they use. This is unsustainable. We all know it. So what do? Are they going to cut spending? No, nobody's going to cut spending. Biden just said he wants to spend $7.3 trillion starting this fiscal year. What? So that's okay. So it's political suicide. Nobody will do it. Everybody wants to spend money for their constituents. So you can do that. You can raise taxes, which he's talking about raising taxes on billionaires. The amount that he's talking about raising is just a drop on the bucket. It's going to take, I think it takes care of 3 days of spending each year is what he's talking about. It's ridiculous. So that's not going to, raising taxes. Ultimately, if you raise taxes on companies and people, it just doesn't work. It disincentivizes productivity. It disincentivizes reinvesting back into your company and products, and so your productivity ends up contracting eventually. And so you have a higher tax rate on lower productivity. You get to the same spot. And so, or you could just keep issuing bonds, which we do. We just keep borrowing. But if you do that, you have to allow for high structural inflation, which we're also doing. And that's the path we're on. And we're just going to continue doing it until it just spirals out of control. It'd be like, whoops, helicopter blade came off and that's it.
If you like that clip, then you definitely got to check out this next spicy clip. I think you're really going to like it. Come on, check it out. But if you want the full version, the full interview, check that out over here. Come on, do it. I'll see you in there.